Management Company Limited Q1 and FY27 earning conference call hosted by Rick Capital. We have with us today from the management Mr. A. Balasubramanian, Managing Director and CEO, Mr. Pradeep Sharma, Chief Financial Officer, Mr. Paritosh Chitora, Head Investor Relations. As a reminder, all participant line will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. Before we proceed with this call, I would like to take this opportunity to remind everyone about the disclaimer related to this conference call. Today's discussion may be forward-looking in nature based on management's current beliefs and expectations. It must be viewed in conjunction with the risk that a business faces that could cause our future result, performance, or achievement to differ significantly from what may be expressed or implied by such forward-looking statement. I now hand the conference over to Mr. A. Balasubramanian. Thank you, and over to you, sir.
Thank you. Good evening, everyone. Thank you all for joining the call for Q1 FY27 investors call. I hope you all had the opportunity to read through the earnings presentation. It's available on both the stock exchanges and our company website. Let me begin by sharing our perspective on the current macroeconomic environment. The global economy, as is known, has shown real resilience this quarter, navigating uncertainty from the West Asia conflict with limited impact on activity so far. We come into an uneasy kind of the IMF projects global growth moderating to about 3% in 2026 and before improving to 3.4% in FY27 as war-related disruptions gives way to the strengthening of AI and technology investment cycle. Inflation may rise modestly, keeping central banks cautious on easing. Risk from geopolitics, commodities and trade fragmentations remain, but the outlook is more balanced with a resilient demand and technology-led productivity gains. India has handled this crisis better than most energy importing economies, held by diversified imports, timely policy action, and strong buffers and regulated fuel pricing. That said, the higher import costs have pressured the external account with some pass-through into domestic prices. That's why we are seeing the SNR, the deposit also being announced by RBI. And growth remains supported by strong private consumption and steady services, improving investment and healthy balance sheet of companies and continued government capex. The key risk is the monsoon, with the IMD expecting below normal rainfall due to El Nino. Though comfortable food grain stocks, healthy reservoirs, and better supply management should soften and food prices impact compared to the past years. And overall, the near-term challenges are real, but India remains on track to be among the fastest-growing major economies. Coming specific to the equity markets, Indian equities were volatile but broadly resilient this quarter, with sentiment shaped by domestic strength, earnings expectations, FII flows, and global developments. And while large caps stayed range-bound amid votes of profit booking, and broader markets outperformed with the Nifty mid-cap 150 and small-cap 250, both posting gains. And despite FII outflow at various points, sustained domestic institutional flows and improving macro fundamentals helped Indian equities to close the quarter on a stable note. Coming to update on mutual industry, the quarterly average AUM stood at 83.14 lakh crore as on 30 June 2026, compared to 78 lakh crore as on 30 June 2025, registering year-on-year growth of 14%. The SIP contribution for industry stood about 31,780 crores for June 26, representing year-on-year growth of about 70%. Total mutual fund folio stood at 29.1 crores as on June 2026, growing by 19% year-on-year, with the unique customer close to about 5.7 crores. During Q1 FY27, the industry saw total NFO collection of approximately about 1,759 crores across equity and debt mutual funds, with equity collections driven by index funds, aggressive hybrid fund, and value funds. And despite equity market volatility, industry witnessed continuous flows into various schemes, highlighting sustained investor confidence in the long-term growth potential of Indian equities, though we witnessed marginal slowdown in the overall SIP flows. Individual average AUM for June 2026 stood at 51.08 lakh crore, contributing about 61% of total AUM. These cities an average AUM of 13.6 lakh crores, accounted for 18.5% of the total AUM, growing by 13% year on year. Coming to the ABS AMC performance highlights, at ABS AMC, we are pleased to announce that overall average AUM, including alternate assets, surpassed the 6 lakh crores milestone this quarter and now stands at 6.28 lakh crores, reflecting robust 42% year-on-year growth. This includes the mandate received from both ESIC and EPFO. EPFO got added in the last quarter. Therefore, the overall average assets for about 1.5 months got added to the overall assets and management. We are pleased to share that we have been entrusted the EPF mandate approximately about 6.08 lakh crore. With this landmark addition, our closing total AUM as on 30 June 2026 crossed the 10 lakh crore milestone. This achievement reflects the trust and confidence our clients and partners have placed in us over the years and stands a testament to the strength of our franchising and investment capability. Our mutual fund quarterly average AUM stood at 4.28 lakh crore, representing 6% year-on-year increase. Within this, our equity mutual fund quarterly average AUM stood at approximately 1.99 lakh crore and growing about 10% year-on-year. Our equity mix for the quarter stood at 46.5%. Our SIP contribution for June 2026 stood at 1,083 crores, supported by 40 lakh folios contributing to the SIP account. The total investors folio for June 2026 stood at 1.11 crore, with the new SIP registration for the quarter is approximately about 5.5 lakh new SIP registrations. Our SIP book remains a cornerstone of our long-term wealth creation strategy. Through campaigns like Sabse Important Plan, we continue to reinforce the value of discipline and systematic investing. To take our SIP book to the next level, we have launched the focus initiatives for both employees and partners, and we expect these to drive our stronger outcome in the quarters ahead. Though we have seen this quarter a marginal reduction in the SIP's book, but something we continue to remain a big focus area to drive the next level of growth momentum. Our investment performance continues to demonstrate strong consistency and meaningful improvement across both our equity and hybrid portfolios. For the past year, we remain focused on strengthening our investment capability, enhancing our investment team, and refining our portfolio constraint investment framework. In fact, it is reflecting on the overall performance improvement, not just on only in the short term, even in the medium to long term, our performance have been showing an improvement. And these efforts have translated into significant not only performance, it also strengthened the investors' confidence and supported healthy inflows across our flagship offerings such as Flexi Cap, Balanced Advantage Fund, Mid Cap, Multi Cap, Small Cap, Index Fund, where we have seen the inflows on a month-on-month basis showing an improvement. In fact, most of these funds now also feature on the recommendation list of our banking channel partners, which will further support flows in going forward. In fact, this quarter, our product got added to the two of the large banks as part of the recommendation list, which I hope to improve the overall sales numbers from these channels as we move forward. Strengthening and expanding our distribution network remains our key priority in order to improve the overall sales productivity. In fact, I have undertaken what's called Yatra across various cities in India in order to meet all our distribution partners and the investment community at large. These interactions have brought several insights from the ground, what customers are thinking and how we are perceived by the market. This has given us a great confidence that we are on the right track towards growth, building on the legacy, goodwill, and market equity that we have garnered over the decades. Technology and innovation remains at the heart of our customer-first approach, and our efforts to enhance the overall investors' experience. As part of our digital transformation journey, we have launched a series of technology-led initiatives. Our GenAI-powered chatbot is designed to engage investors early in their decision journey, understand their needs, and guide them towards relevant investment actions without requiring human intervention. We also launched our new distributors and investors app, enabling enhanced portfolio tracking, seamless transactions, and improved business management. In addition, our WhatsApp-enabled servicing platform helps investors and partners access services more conveniently and efficiently. And turning to our alternate business, we witnessed good growth during the year. Our PMS and AIF assets increased about 20,650 crores as of Q1 FY26 to nearly 2 lakh crores, which includes EPFO flows. And this growth was largely supported by ESIs and EPFO mandates, which I mentioned about it earlier. We also launched ABSL Sector Fund during the current quarter, and the fundraising is still underway. Along with that, we also have fund launches which is a Structured Opportunity Fund 2, and Money Manager Fund, and India Select Sector Fund, in addition to the Special Opportunity Fund Series 2, in order to build our PMS and AIF portfolio. And these offerings are broadly in line with the investors' demand and from differentiated portfolio and investment opportunity point of view. In our real estate business, our AUM stood at approximately about 700 crores, reflecting a 28% year-on-year growth. And fundraising is currently underway for the Aditya Birla Real Estate Credit Opportunity Fund Series 2, which focuses on senior secured lending opportunities and post-approval brownfield real estate projects across Tier 1 cities. With the recent grant of our retail license at GIFT City, we are enabling NRIs and global investors to seamlessly access both inbound investment into India and outbound opportunities across global markets. And building on this momentum, fundraising is currently underway in our ABSL FlexiCap Fund, which is a feeder fund. We have seen a marginal success in this space to get money from NRI investors to invest in India feeder fund through the FlexiCap Fund. We are also on track to launch a retail product via GIFT City in the upcoming quarter, including Emerging Market Equity Fund and India Growth Fund, and also launch series of index funds to invest in global market. By a growing product suite and GIFT City global investment ecosystem, we are well placed to build a scalable offshore franchisee in the coming years. Let me now turn to our passive business, which remains one of our key strategic focus. We continue to see significant opportunity in this segment and remain committed to building leadership position through a comprehensive product suite, a strong distribution network, and strength of our brand. To further strengthen our business in this space, we recently appointed Hemant Bhatia as head of our passives, along with a team of people under him. He brings more than 2 decades of experience in building passive and ETF business in India, and we assume will play a critical role in driving product innovation, strengthening investment capability, and accelerating growth in the segment, as well as add new customer base through this business model. And during FY27, our passive quarterly average AUM stood at approximately about 47 crores, representing 14% year-on-year growth. Our investor base also continued to expand, with the total folio of reaching about 17.4 lakhs. Within passive, our ETF franchisee delivered particularly strong momentum. ETF quarterly average AUM grew by about 47% year-on-year, significantly ahead of the industry growth about 29%. And today, our passive product suite comprises of 52 offerings and spanning equities, fixed income, and commodities, and the master solutions, and enabling us to carry out a broader spectrum of investors' portfolio. In the Apex SIF segment, we launched our first Apex SIF Hybrid Long Short Fund, and backed by our strong investment team. So before building our size in this space, we want to establish performance trackers for 6 months. Now that the 6 months is over, now to start building a size in this space. In order to build a further momentum, we are also now preparing to launch 2 more SIF Equity Long Short Fund and Equity X Top 100 Long Short Fund. And these additional further scale our SIF platform, tapping into the new product segmentation, which I think we can build size. And also to support this business, we strengthened this team by adding 2 more specialists to run these products for us. Moving to financials, Q1 FY27 total revenue is about 625 crores as compared to 565 crores, with Q1 FY27 up by 11% year-on-year. Q1 FY27 profit before tax for 406 crores as compared to 372 crores in Q1 FY26, up by 9% year-on-year. And Q1 FY27 profit after tax 309 crores as compared to 77 crores in Q1 FY26, up by 12% year-on-year. With this, I would like to open the floor for any questions that you may have. I will be joined by Pradeep to take any of the questions that you may have.
Thank you, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Our first question comes from the line of Swarnabh Mukherjee with 360 ONE Capital. Please go ahead.
Hi, sir. Thank you for the opportunity. 2, 3 questions from my side. First of all, sir, if I were to calculate the yield for the, primarily focusing on the active part of the business and keeping out the AUM for the ESIC and the EPFO mandate. I mean, I can by my calculation, I am seeing some increase in yield. Just wanted to understand whether this is the right approach, and the increase. How should we think about it? Is this an outcome of the TER regulation, and we have actually slightly benefited? If you could highlight on that. Second is also if you could call out the segment-wise yield, that would be very helpful. Thirdly, sir, wanted to understand on the employee expense part, what is the reason for the increase, and is there anything one-off there? And also, if you could call out the ESOP number in that. Yeah, these will be my questions, sir. Thanks.
Sure. Just ask Pradeep to answer the. Yeah.
So, Swan, this BER actually now this was effective from 1st April 26. So that has been rolled out completely, and we have optimized the commission structure along with the management of cost, and this is win-win for both as an AMC for us as well for our partners. So that has been rolled out, and the yields what is there in Q1 reflects the true picture and will be maintained going forward in these levels. Yeah. So coming to the yield levels for equity, it is around 63 to 64 basis points. That it should be around 24 to 25 basis points, and liquid would be in the range of 12 to 13 basis points, and ETF around 8 basis points. So these are the yield levels. Coming to employee cost. Employee cost for this quarter has increased mainly due to the ESOP cost. If you remember, we actually rolled out the ESOP for the employees in Q1 in January, from effective January 26. So this is because of that. The impact of that is around 10 crores per quarter of the additional employees cost through the ESOP. And roughly the employee cost which is there in Q1 should continue in the same range for coming quarters.
Yeah.
Okay, sir. Very, very helpful. Understood that, sir. Just a follow-up on the headline yield number that you have mentioned. So as you said that this is the true picture. Now, how should we think about the overall the dilution of the yields going forward as our AUM increases? And also, if I could squeeze in another question more on the broader industry level, that we are seeing this trend that a lot of manufacturers are focusing on the passive side and the ETF side and planning to develop that. So over the next, say, 3-5 years, how would you be foreseeing the industry, say that from the active side as well as from the passive side? How should we expect things to develop? Yeah, this is my question, sir.
So actually, see, by and large now this the regulatory changes have been now rolled out, and now only thing which will come in play is the telescoping pricing, which will be based on the AUM size, which will grow, right, as you are aware. So what we can do as a business would like to maintain our yields plus minus few basis points. This is the mix which we will be working on through the alternate business. So we feel that going forward the yield should be in the similar range, barring 1 or 2 basis points here and there, plus the telescoping pricing. So you want to add something?
Just to add to that, with respect to the in terms of passive business growth, the way as Pradeep was mentioning, as the size improves, definitely the telescope price will be coming in. But we also believe that active will continue to be the dominant asset class when it comes to the question of overall momentum growth. But having said that, the passive is something in order to build choice to the customers, at the same time ensure that asset allocation remains key. So passive is something we have now invested on people who have a passion towards building passive. the way we are looking at passive is it should help us build scale and get more. At the same time, has to be extremely low cost kind of product. So I think the way we are looking at it will add to the overall profitable numbers, not in terms of absolute profit. Of course, margin could be lower given the fact that we pass on the benefit both to the customers as well as the form of low expenses. But in terms of addition of profit, revenue, as well as the bottom line, that's something is the roadmap in which I think we are planning to drive. Even the GIFT City product that we will be looking at doing, especially for investing in the overseas market, that also we are doing with a similar intention. Of course, the expenses could be lower than the actively managed funds, but at the same time, given the fact it could be relatively lower, but absolute profit that will add to the scheme will remain high. But in terms of mix, I think the way we see is, say today if you look at the passive is about 11 lakh crore roughly is the size. If you knock off mandate-based investments, the pure retail would be roughly about 2.5 to 3 lakh crore. And within that, if you take large component coming from gold and silver, again, it will remain one of the asset class for us to focus, which gives reasonably good profitability as well. So maybe this number will keep rising. At the same time, our intent is actually to build size in the key product, which is where we believe that given the comparable asset class in the same size if you take, given the significant improvement in performance that we are witnessing, we would focus on building a size in our core product, which is what our current focus is, while building our base for the passive and ETF.
Right. So this is very, very helpful, sir. Thank you so much and all the best.
Thank you. Ladies and gentlemen, anyone who wishes to ask a question may press star and one. Our next question comes from the line of Mohit Mangal with Centrum Broking. Please go ahead.
Thanks for the opportunity and good evening, everyone. So you just said that the commission was restructured. So out of 5 bits, how much was kind of transferred to the distributors?
So you want me?
Yeah. So Mohit, actually, so we have optimized the commission structure so that it is win-win for both, right? So there is no on terms of basis points. So we have reviewed the entire whole ecosystem of commission, and we have ensured that it should remain neutral for everyone and win-win for we as an AMC as well as for our distributor partners. And then the outcome is that by and large our yields also remains intact, and by and large distributors also maintain their margins.
Yeah. See, the broad approach we have taken on this space is, when you mean by win-win, is something neither I can make too much profit nor we can take hit at the same time from distributor's point of view also. So when we re-look at the whole model and looking at account, this is only the sharing format that we have. I think basis which our own assessment is significant benefit or the loss. So that's the way we approach. With the marginal here and there, some benefit would have accrued to us, some benefit would have got accrued to distribution community, but broadly we have kept it more like a neutral kind of impact.
Understood. So second question is that we have kind of lost market share in SIP as well. So just wanted to know that even in your opening comments you said that your flagship schemes have been doing well. So where are we seeing problems within the SIP? Is this non-flagship schemes or how should one look at it?
Yeah. No, flagship scheme, our effort has been to build. I think flagship scheme as it is, that our 7-8 flagship schemes we have mentioned, we are seeing improved flows even compared to the last year as well as even this quarter too. I think largely your SIPs, especially in the ELS schemes, we are seeing general outflow in the industry, and we did have impact on some of the ELS schemes. And even industry also this time the cancellation rates are higher than the previous quarter. So to some extent, I would say that has added to the. Of course, sometimes some of the for long. We have seen some cancellation in that. But having said that, the core schemes, that is one of our intent is to core 7-8 schemes that we have identified, is the one where we call it the focus product. There we are seeing an improvement in terms of SIP registration as well as SIP drive. So this quarter was more or less, as a result of what I just mentioned. Then secondly, as far as the fixed income concerns, I think the volatility that we witnessed in interest rates, especially in the month of May. May was actually a little panic month when it comes to the fixed income. And fixed income, we do have large size in the non-liquid fund, liquid 5+ category, which is basically duration based. We did lose some bit of money. In fact, all the money has come back in June end and July. At least for a month, I think it affected in the month of May. Therefore, it got impacted in the average assets. Otherwise, had it gone in the June end, it would not have had an impact. Because it went in the month of May and coming back after a month gap. So it had an impact on the overall average assets.
Okay, understood. This is helpful. Sir,
Yeah.
Data keeping questions. If you can spell out the PMS or AIF for the non-mutual fund revenue for the quarter and the SIP AUM.
So SIP AUM is approx 87,000 crores for quarter, and PMS and AIF contribution, if you see, contribution on total revenue on gross basis is around 7% for the quarter, and on net revenue basis post payout of commission to distributors is around 4% on overall revenue.
So out of 463%, 4% would be PMS AIF revenue, right?
Yes.
Understood. So thank you and wish you all the best for the entire year.
Thank you.
Thank you. Our next question comes from the line of Lalit Mohan Dev with Equirus Securities. Please go ahead.
Thank you for the opportunity. Thank you for the opportunity. So I have two questions. So firstly, on this, in this particular quarter, you just mentioned that we are seeing some healthy flows in our flagship products. So just wanted to understand if you could give some more color into it, like in terms of the market share, how is it tracking with respect to our overall AUM market share in flows in those particular schemes? And also, if you could also give some color on from a channel-wise perspective, like where we are seeing some healthy flows and where we are seeing probably some redemptions over there, probably on the distributor side or the banking channel.
Yeah. See, with respect to these core funds, we are seeing, though I not track the exact how much is the improvement in the market, I generally look at the flows. The core funds such as Flexi Cap, Balanced Autonomous Fund, Multi Cap, Small Cap, even a Mid Cap, and the Multi Asset Gain Fund. These are the generally core funds, including I am even seeing flows coming into a PSC equity fund given the fact that good performance track record. And we are seeing flows in these core funds. And our idea is actually to ramp up the flows into these funds by keeping this as a high focus area for the entire sales team across the country. And wherever even I've been traveling with my sales team across the different parts of the country to push towards overall engagement. I do see positive vibes coming from each one of them, acknowledging that some of our fund performance is even doing better than the competing funds in the same category, where the volume would have gone in the last 3-4 years. That's something is there is high realization which is there. And second, with respect to your with respect to the channels, more or less steady growth, but I see MFD volumes gradually is picking up. With the banking channel, earlier some of our products were not part of the approved list. We already started seeing products becoming part of the approved list. Recently, HDFC Bank has approved some of our products, and Kotak team onboarded some of our schemes. And we have seen already product approved part of HSBC, S Securities, S Bank, as well as on Standard Chartered Bank and also some of the other wealth management firms, including LGT, Ask Wealth, and IndusInd Bank. Some of our products were probably missing as part of their comparison, such as FlexiCap Fund, Balanced Automatic Fund, even our equity savings fund on the fixed income category. These are now getting added to the overall recommendation list, which in my belief is, given the fact that our engagement is pretty good, and also they normally sell the products that are part of the recommendation list, I see improvement coming from sales engagement leading to a better outcome from these channel partners. We are already seeing this coming in some of the bank channel partners. In fact, HDFC Bank added only a FlexiCap Fund only in the last 2 weeks. Adding to overall AUM growth.
Sure, sir. Thank you for that detailed answer. And so just one data keeping question. Could you also spell out the total number of employees as of June end?
Yeah. So total number of employees as on June end is 1638.
Sure, sir. Thank you.
1638.
Yeah.
Thank you. Ladies and gentlemen, anyone who wishes to ask a question may press star and one. Our next question comes from the line of Abhijit Sakhare with Kotak Securities. Please go ahead.
Hi, good evening, everyone. So my first question is a clarification on the data. When I look at the slide number 11, where you have the closing and the average assets under management, just wanted to clarify that I would have thought the equity AUM, the closing AUM, would be slightly higher than the average for the quarter, given the returns from the market and what we've seen with other players. So just wanted to clarify that first. And second question is, in terms of the ESIC mandates, if you could give some idea in terms of what would be the annualized revenue from these mandates. And last question, sir, would be just a qualitative one in terms of flows. What would you say would be, say, top 2 or 3 funds where you expect maximum flows in the next 12 months? Thank you.
So, on the closing AM, you see?
No,
Yeah. So, in
top 2, 3 funds.
Yeah. So, in terms of, take the last question first. In terms of funds that we see position with respect to the competing funds, also the funds which remains relevant from the broader distribution community point of view, and when it comes to an allocation of money. First and foremost, FlexiCap Fund. Second is Balanced Automatic Fund. And third is the Multi-Asset Allocation Fund. And fourth is the Small Cap Fund. Though we don't position mid cap at this point of time, we also wanted to do a justice in showing a high conviction on that space. But however, we are seeing some of flows coming in. Among the thematic and purely fund also we are just positioned, but otherwise largely these 4 or 5 funds. In the hybrid category, both the SIF, the new one that we have launched, as I mentioned, we want to establish performance track record before we start pushing it. Now that we have in place, again we are driving that from an overall flows point of view. And equity savings fund again comes to the equity taxation from a view. The large pool of HNI investors who does not have major expertise in terms of equity return, that also we have positioned. In fact, some of the conservative investors we have positioned that as a scheme for flows. So that way broadly we are positioned, but the key schemes largely remains FlexiCap, Multi-Asset, Balanced Automatic Fund, and Small Cap. With respect to the AEM, ESIC mandate, of course, in terms of the revenue, very marginal. We don't earn any much on this. Of course, we do have a team of people who actually have a separate team of people for managing both EPFO and ESIC mandate. That's what it's a requirement is. But otherwise, in terms of revenue, it doesn't add much revenue to us. Like that doesn't give you big revenue, but definitely is open the gate for privately managed EPFO, through which we are seeing some of tractions in terms of flows coming to us. Passive funds as well as actively managed funds, though it's a small beginning, but we are giving a complete re-push. Rather, we are emphasizing the need for reaching out to 1,350 EPFO to contribute from their equity contribution to our existing funds, purely on the basis of the mandate that gives us the edge over others for us to get closer. In terms of closing versus average, Pradeep is just giving you a clarification on that.
So Abhijit, average equity AUM for quarter one was 1,98,722 crores, and closing also was 1,98,969 crores. So because if you see in during the quarter, there were dips in the market, and that's why the average also is in the range of closing only. So I think you were saying that why this is in line with closing, there should be some movement on basis the market movement. But if you see over during the quarter April to June, there were days wherein market also has dipped. That's why average is also in the similar line.
Got it, sir. And sir, last question, Pradeep sir, any OPEX growth outlook for the year?
OPEX, I think remain within the inflationary guidelines. Employee cost, as we discussed in the first call, was in employee cost should remain largely in the similar range, as we have already factored in the ESOP cost, etc., which based on for the new ESOP plan which was rolled out for the employees. Other than employee cost, it should largely remain with as per the inflationary normal inflation. There are no cost shocks, I think, as of now.
Yeah.
Got it. Thank you so much.
Thank you. Ladies and gentlemen, anyone who wishes to ask a question may press star and one. Our next question comes from the line of Dipanjan Ghosh with Citibank. Please go ahead.
Hi, good evening, sir. So a few questions from my side. First, if I look at your non-mutual fund portfolio, and this is excluding the large mandates from EPFO and ESIC that you have received. And if I look at the AUM, X of that average AUM, I mean from 1Q24 to 1Q27, which is almost a 3-year horizon or 2-3-year horizon, I mean things look largely stable in terms of the average AUMs, X of the large mandates. Despite kind of onboarding new teams, strengthening the sales franchisee, etc. So just wanted to understand. I mean, if I were to take a 2 to 3 year view, I mean, given that the market space has kind of widened, your franchisee has deepened. I mean, how should one aspire to either look at AUM or revenue contribution from this X large mandate non-MF book? So that's the first question. The second question comes back to the SIP market share. Now, if I understood correctly, you mentioned that ELSS has seen some amount of rundown and maybe a little bit of pressure in terms of flows. Now, correct me if I'm wrong, my understanding would be that ELSS contribution to SIP at an industry level might not be that relevant. So unless ELSS SIPs for you guys are a meaningful contributor, triangulating the SIP market share decline quarter on quarter, or at least from March to June, looks a little challenging. Or in case you can give some color on that, or maybe the quarterly SIP data, that would be useful, X of maybe ELSS also. And third question would be on the fee and commission expense. Is it fair to assume that the increase that you're seeing in fee and commission expense over the past few quarters is largely attributed to the alts and non-MF business basically, and that should kind of remain robust given the product pipeline that you have? Those are my 3 questions.
Yeah. So with respect to the first question around the AIF side, see if you look at our alternate business, into 3 categories. One is the PMS long only equity, which is in the listed space, where we have roughly about 5,000 crores kind of size. And while we have grown with the last that's an asset class, we want to build size. In fact, already part of some of these leading wealth management team approved list. Definitely, we have a target to take it to anywhere between 20-25 crores over a period of next 3 years. The second category is we have built, where we have built capability, internal capability, as well as the team, is to build AIF performing credit, as well as the AIF money market fund in the AIF category. And third is the AIF real estate credit fund. Real estate credit fund, we have established reasonably good track record return to the investors. The same way AIF performing credit, so far we have been able to deliver close to about 14% return, which again it's being seen by people underwriting that we have done, reasonably acceptable underwriting we have done. With that, our intention is to build the size to the next level. I think each one of them we will gun for about anywhere between to 7,000 crores kind of size to start with. That is one of the reasons we also given a commitment from our AMC P&L in order to provide seed capital up to 10% of the fund size. At the same time, we'll provide a temporary bridging gap whenever they have a deal, so that we can participate in some of the large deals, at the same time get money into the fund. That is the model we have applied as far as the AIF credit performing credit funds. And third is of course the GIFT City. GIFT City is something now that now got the retail license. Clearly we have a roadmap in building GIFT City, both for inward remittance and outward remittance. In fact, the 3-4 gentlemen who are joining on our passive side, they are quite convinced and quite bullish in terms of building GIFT City as one of the route for domestic savings to get diversified into the international equity market. Therefore, we will launch a few products in that segment. That is what I think will build the size. As far as the domestic concern, even the passive side, some of these institutional investors as well as HNIs who largely chooses the passive funds as part of the normal asset allocation, that also we have put some kind of in place. In fact, the new team of people is also quite convinced and passionate about building passive. Therefore, this is something which the fourth category will do. That's why we are building the overall size. In fact, the way we always drive our alternate business should not only attribute to the overall AUM growth, but it should also attribute to overall profitability, so to speak. That's the way we built. And the second question, Pradeep is just answering.
Yeah. So SIP cumulative contribution for the quarter was around 3,300 crores, which is actually in line with Q4 numbers also. So in fact in Q4 also the contribution was around 3,300 crores. However, there have been month-on-month fluctuations. So this is one. And secondly, you asked about the alternate revenue. Revenue. I think largely we feel that because all our verticals, LOBs are so largely we feel in coming quarters, I think the revenue or contribution for alternate should be in the similar range, except 1 or 2% here and there. I think should be there because all our LOBs are firing, so all our LOBs are growing. So we feel that in coming quarters, this should remain in the same range.
Yeah. See, alternate, while we are seeing some kind of pickup, I think increasingly we are seeing acceptance for the product. Ultimately, that should lead to a volume conversion, which is what my belief is will start. Even PMS, there are certain markets where we have been pushing, even at the MFD level, is also seeing some kind of success. So that's something which we believe that as we move forward, we will see uptick, gradual momentum in this space.
Sure. On the fee and commission expense increase, is that partly attributed to new launches and marketing expense in the all PMS businesses?
Yeah.
So fee and commission expense is actually directly linked to the business of alternate business, because this is the commission which is paid to the distributor community. So I think that is directly linked to the business which we will be garnering on the alternate side. So I think this should have similar growth rate of our revenue for alternate side.
Got it. Just maybe one small question, if I can squeeze in. You mentioned that you normally tend to look at absolute flows rather than the market share, which looks fair. So if you were to index your flows to 100, let's say in 1Q26 or 4Q26, how would the trajectory be tracking incrementally, let's say, for the quarter on a run rate basis? I mean, indexing to 100 a particular base quarter?
I think generally I see improvement over, of course, when I would look at the numbers very, very objectively from last year, similar quarter, this year, similar quarter, the numbers are better. But if you look at last year full year run rate versus the 3 months run rate is actually better than the last year full year run rate. But however, when we began this year, just to give you some sense, April was pretty good for us. April was it started quite well, and May generally was May and June was relatively muted, as we have seen generally in the equity market. But otherwise, the trend is largely getting better as far as the key funds flows are concerned, which is what I mentioned. Rather than comparing with the market share right now, how the flow is improving is something. I think once it gets established, it comes in auto mode, then naturally we'll be able to link that onto a improvement in the gap between competing from the same space. That's why we start looking at it. But I think we'll have to give some time for that. Now that the products are coming as part of the recommendation list, and now that the performance, the longer term also now is getting better. So that's the way normally I see it.
Got it. Thank you, everyone, and all the best.
Thank you. As there are no further questions from the participant, I would like to hand the conference over to the management for the closing remarks. Thank you, and over to you, team.
Yeah. Thank you, everyone, for with this, we'll conclude our Q&A FY27 earnings call. If you have any questions, please feel free to contact Pradeep and Paritosh. Yeah, thank you.
Thank you so much, sir. On behalf of Aditya Birla Sun Life AMC Limited, we would like to formally conclude this Q1 and FY27 earning conference call. We sincerely appreciate your participation in this event, and we kindly request that you may now disconnect your lines. Thank you for your time and engagement. Have a great day.